IVM.
Why are Indian banks in so much trouble? Why have so many of their loans gone bad? And how can the government of India plug $100 billion hole in the banking sector? Welcome to this episode of the Pragati podcast, where we discuss all this and more. The Pragati podcast is a weekly talk show on economics, public policy, and international relations. We are your hosts, Hamsini, Hariharan, and Pavan, Srinath. My apologies, I'm recording this with a sore throat and a blocked nose. But before I was under the weather, I was fortunate enough to have Narayan Ramachandran join us in studio to talk about India's banking crisis. Narayan is the chairman of RBL Bank, a former country head of Morgan Stanley, as well as a co-founder and a fellow at the Takshashila Institution. He writes a regular column in Mint called A Visible Hand. Narayan, welcome to the show. Can you take us back to the origin of this banking crisis? Where did it start? Why do banks have these loans on their balance sheet that have gone so bad?
So first, I think, world over, banks have occasionally hit trouble. For those who don't follow the banking system every day, a bank is a leveraged entity, often leveraged 10:1.
Okay.
Right? So when things go well, it goes really well. And if things don't go well, then they go rather badly because of that leverage. Yeah. So think of it as a treadmill. If you're running at the right speed, then you'll be perfectly in sync with the treadmill. But if you're off key with the treadmill, then you fall off. And so the banking sector broadly, because of the leverage, is like that. Some people have actually likened the banking sector as a hedge fund on the economy because of its fundamental leverage. Works very well, again, during good times, and not so well when things are not so good.
So essentially, every day, every year, you're borrowing to pay back previous borrowings. Is that a good way to look at leveraging?
Yeah, I mean, that's when you say it that way, it doesn't sound so good, except that you're actually refreshing, you have $1 of equity and $9 of debt, and you create a balance sheet, and then you lend out some $7, $8.
Right.
Or equivalent in rupees. So that's exactly what you do in banking. And if you're doing that with fresh ideas and fresh proposals, and that 7 is getting paid back, and then you're reissuing a 7 to a new set of people, or over time, the 10 itself is growing to 15 and you're doing that to more people, then that's how a healthy banking system works in general, right? The problem is when some of that money, that 7 doesn't come back. And 2, when that 10 doesn't grow to 15 for a variety of reasons. So when you have both of those problems, and particularly if both of those problems occur at the same time, then you have difficulty. So tracing the origins of the Indian current banking crisis, I would say it's twofold. One is quite literally a consequence of the global financial crisis of 2008 and its implications for some of the global sectors. So wherever you have a global commodity, for instance, steel, and steel is actually now made in multiple countries and traded around the world. Now, in the period leading up to the global financial crisis, people sort of assessed that there would be insatiable demand for steel and consequently put a lot of capital and equipment in for the making of steel. Those steel producers, particularly those from China, but certainly also from other countries, Canada, Japan, Korea, etc., are all making steel even now. And the demand for steel is not quite there in a somewhat muted world after the global financial crisis. So in some sectors such as steel, which are global, or cement, which is national but still suffers from perhaps moderate excess capacity within the national borders of India, there I would say the consequence of just demand turning soft is what has resulted in large-scale difficulty for the banking sector. So one part of the difficulty is that. The other part of the difficulty is man-made, if I can call it that. And by that, I mean it is either a combination of exuberant entrepreneurs, founders, just, going crazy in terms of putting new plant and equipment in, where at any time there was really no demand to speak of, or certainly demand was much short of what the supply was going to be. Or it was what is now widely written about, which is that banks, in particularly public sector banks in India, have a very lax sort of governance structure. And that governance structure has had both political interference and has had outright fraud. So PNB, for instance, is outright fraud.
Right.
But in several of the other instances, with some of the larger public sector banks, it's actually just political direction and political interference that has caused bank systems those loans to go sour. So I would say three big pockets of reasons why we come upon the banking crisis we do today. One is, to repeat, one is just a result of demand going soft in a world that was expecting more post the global financial crisis. Understandable, but there. The second part is, entrepreneurs, founders becoming very, very aggressive, not having enough equity to back their projects and taking on excessive leverage, compounded by a very loose regulatory and not regulatory as much as loose governance framework for public sector banks that has created both political interference and fraud. So three sort of buckets of reasons why we have the banking system crisis that we have today.
So we've seen this develop over quite a few years, right? I mean, people have been able to see this coming. What has been done to sort of manage this problem in the last few years? Has anything been done?
So, I mean, it's the metaphor of falling off the treadmill is quite literally the case. Once you fall off the treadmill, it's not difficult to put an injured person back on the treadmill and make sure they're running at quite the same speed that the treadmill needs to run and to be in sync. So we're in sort of that limbo zone even today.
Okay.
Just to size the problem, again, there's no precise number, but my own sort of estimates suggest that we have something like a 6,500, 7,000 crore problem.
Okay.
Hole in the balance sheet, if you will.
Okay.
That results mostly from the NPA crisis, but also a little bit from requiring a little bit more capital for a new set of regulations called Basel III.
Okay.
So if you add those two up, let's call it 7,000 crores, a little bit more than $100 billion.
I want to clarify here that Narayan meant that the size of the hole was 650 to 700,000 crores, not 6,500 or 7,000 crores. And this translates to about $100 billion. For context, that's about 3 times the size of the government of India's annual budget.
Most of that, not all of it, but most of that is to public sector banks. Some of it is to a few of the private sector banks that are in trouble at the same time. So that's a large sum of money. And it requires significant, and given that it is largely focused on the public sector banking system, it requires a very heavy focus from government to fix it. And that fixing is not purely a financial problem. It is also a political problem. It is a labor problem. It is a election year problem. So you have sort of this little multiple wheels sort of spinning each in its own direction. And so far, while there have been modest attempts to fix it, for instance, banks buying in a way, banks are financing themselves by buying the debt that's raised by government and put in back by equity.
Right.
So that's like a circular funding that, works for a little while, but doesn't work for the longest time. There has been a long standing requirement to separate the good bank from the bad bank, as it were. And that requires significant political will, particularly given that a lot of these problems are in public sector banks.
Right.
And so truly the solution will lie if you can separate out these bad assets into a resolution process and allow the good banks to function.
Okay.
Recapitalizing the banks, you can try.
Mm-hmm.
And some, I think, good banks, some of the better banks in the group need to be recapitalized.
Okay.
All of them need to be recapitalized, but some of the bigger banks should be recapitalized.
Mm-hmm.
But the problem is then the moment they are recapitalized, there is a political and labor-based clamor to merge with a weak bank. And so it's in a way you're saying make the strong slightly stronger, but then make them weak immediately by merging with a small bank.
Mm-hmm.
As sort of counterproductive. So truly, I know some of you may recall that the US after the financial crisis did a program called TARP.
Mm-hmm. Toxic Assets Recovery Program?
Reconstruction Program, or Reconciliation Program, whatever. So if effectively the plan was simply to separate into good bank and bad bank.
Mm-hmm.
And if you did that, and the government did do that and put in money and actually ended up making money.
Okay.
So you need that sort of clean strike of the cleaver, so to speak, in order to put this on a path to success. And then if you do that cleanly and strongly,
mm-hmm.
then the public money that goes into supporting these things will actually make you money. And therefore the political accountability becomes that much easier because the money you put in actually returns money to you eventually.
Right.
Whereas if you take a loosey-goosey gradualist approach, which we have so far been following,
mm-hmm.
then you've not done it because you don't have the political will, but by doing it in a half-baked manner, you will not get the returns, which then further compounds the political accountability.
Right.
Right. So we are a little in this warp where we haven't yet fully been able. I think, politically speaking, this will have to wait till next year.
Okay. Not going to happen before the election.
Not happening till 2019, just purely from the political calendar.
Okay.
Too many state elections this year and then the national election next year. So I suspect, given the strong political implications, that the true resolution. But then if we're lucky and if the government of that day can summon the courage, then it should happen very swiftly after that. Because in a way, it's best to take the fall in the first year of a new administration. So I'm hoping, therefore, that the second half of 2019 will produce strong, clean, fast setting in motion of the real resolution.
Okay.
But so far, I would say we've been paying lip service to the problem rather than actually doing too much about it. So
does it make sense to split the NPA problem into a stock and a flow issue? Are we still signing on? Are banks still giving out credit to people who may not be very creditworthy? Or has the flow problem been managed now? It's a stock issue.
Well, actually, we have, in not quite the way you say it, but we have both a stock and a flow problem.
Mm-hmm.
So we certainly have a stock problem. That's the one we've been discussing so far. But we have a flow problem because what little chance some of these banks had of potentially working their way out of the problem by on margin doing absolutely the right thing has been stopped for some of them by diktat that says you're so badly off you can't lend.
Okay.
So within the larger group of institutions that are in trouble, there's actually a subgroup that by regulation now cannot lend.
Okay.
Actually has to pare back. So, and what's the thing to do? The only thing they can pare back is the best loan. So not only cannot they lend, they cannot even retain the loans they have. They're actually asked to shrink their balance sheet. Because they've been asked to shrink their balance sheet, the easiest thing to sell is the good loan.
Right.
So it's a double whammy. You're not allowed flow on good new credit. And the stock of good old credit is actually reducing because you're left with an adverse selection of poor old credit. So you're actually, in a way, at least for a few banks, you're making them fully bad banks, which is not easy thing to do. I think people haven't thought through that carefully enough. Some banks will be 40-50% bad.
Okay.
That is unsustainable. I mean, a bank will go bust if it's 10% bad. So 50% bad is rotten.
Right.
There's no way around it. There's no bailout possible. You just literally have to write it off. So I don't know whether there's people of him being naive about it or what's happening. But we are creating bad bank, good bank in a very odd way. Some banks are becoming fully bad.
Okay.
By this adverse selection and stock and flow that you were just mentioning.
Right. Yeah. Okay. So now, is bank privatization, is the fact that some of these banks are nationalized, run by the government, a part of the problem? And if so, is privatization the solution, or at least part of the solution?
So I'll answer this two ways. So the real issue is accountability, right? And accountability can come in the public sector and can come in the private sector. So it's not that the inevitable answer to this is privatization, right? The best answer to this is create a system of accountability. Now,
so that is the RBI having more regulatory capacity, more oversight.
The RBI having equivalent regulatory capacity as it has for private banks is even sufficient.
Mm-hmm.
That's number one. That's one element. Second element is where many of these are listed entities, so that SEBI, which is the stock market regulator, should have equal power on public sector banks as they have on other institutions.
Mm-hmm.
Third, at least from a listing point of view, obviously from a banking governance point of view, it belongs to RBI, but from a listing point of view, SEBI should have that same authority. Third, the board and executive management decisions should be independent and not have political interference. Now, of course, that's easier said than done if the person who is in charge is being appointed by government. So it's a non-trivial issue. An excellent paper on this regulatory framework for banks was written by a gentleman called P.J. Nayak some 4 or 5 years ago. A bit tragic that not a single element of that paper has been implemented to date. But it has excellent solutions about how you would create accountable governance frameworks. So I think the answer is to either put in a layer in government that, for instance, an agency in government that has authority to shield from political interference, and then create institutions under that authority or stick all of these institutions in that authority, or privatize, or both.
Okay.
My guess is the answer will be both. That India can and should actually have some public sector banking institutions, and they should be governed by a banking standards board, if you will, or some equivalent that holds the equity share of the government in one single place, but protects the banks from political interference, but yet maintains overall political accountability or accountability to the people for their actions. So I think that's the way it should go. I think this wholesale notion of privatization, and if you take, PNB, or if you take the related case, which was the Gitanjali Gems case, which is still ongoing and open, there are a few private sector banks involved, and they haven't crowned themselves in glory. So accountability is the answer. Whether they are accountable in the public sector or private sector, whatever it is, they need to be accountable. And that's the both enforcement, regulation, pride, things that are old-fashioned in some ways need to be reinstituted in the banking system, because ultimately they're public trust institutions, whether they are private or public. And that's what I think we need to get back to.
Okay. So supposing we don't manage this problem well in the next few years, how exactly will the consequences pan out? What does it mean? Does it mean that access to credit will become more difficult in the country, or what does it mean?
Well, it already has.
Okay.
So, if you look at credit growth in the country, it's been abysmal for the last 2 or 3 years.
Right.
And the prospects for it continuing that way are there till the banking system is solved. Now, on margin, private sector banks are taking market share from public sector. So some of that problem is mitigated, but not at the scale that you need it, because public-private sector banks are much smaller overall. And in stock terms, as you know, 2/3 of the banking system is public sector and 1/3 is private. On margin terms, maybe it's 90-10 today. But even then, it's only slowly changes. It doesn't change radically overnight. So I think, slow credit is definitely one consequence.
Okay.
Also a pause in innovation and ability to create new product, and just the banking system sort of lagging the economy by 3, 4, 5 years creates all manner of catch-up issues that are not easy to tell at a moment, but are palpable, every 3, 5 years that you keep moving forward. So as India's economy doubles and triples, we needed a banking system that was not 4 years behind, but 6 months ahead.
Right.
And we now have a 4-year catch-up for at least 2/3 of the banking sector. That's not a good situation to be in. And the biggest impact is credit growth. And the biggest impact of credit growth, obviously, is GDP directly. And the cost of GDP is that you delay prosperity by 1 quarter, 2 quarter, 5 quarters.
Right.
And that has serious costs.
So apart from this, if a bank fails, for example, it's also a huge cost to the exchequer, right, to bail a bank out. So that's also something that can happen?
Theoretically can happen. Hasn't happened in India.
Okay.
So in our managed system so far, even failed banks have been unfailed, if I can call it that way.
Okay.
So we don't know if some large-scale bank fails, how the government, which technically is the owner, will actually back their IOU. Is unknown. And for the first time after the PNB crisis, you're hearing that worry. Till the PNB crisis, there was this cast iron confidence that the government stands behind the public sector system. After the PNB, for the first time, you're beginning to see some chinks in that armor. Are they really as, will they be backed to the last day, to the final hour, so to speak, or not? And frankly, maybe the government itself doesn't know. It may depend on the magnitude and speed of the problem.
Right.
So I think, there's another reason for us to fix the NPA, and that's that, right? Which is, we haven't seen a large-scale bank failure in India. And particularly in the public sector system, we don't know how that will actually play out.
Okay.
Smaller banks have not been allowed to fail in India.
Okay. So I have 2 questions, and we'll sort of close with that. One is, does India having a large fiscal deficit compound this NPA problem? Is there an interplay there? And then I'll get to the second one.
Yeah, I mean, on margin, if India had a fiscal surplus, you could go to a fiscal deficit and use some of that money to at least partially bail out the banks. So yes, in that sense. But for a growing economy to have a fiscal deficit at the central level of 3% and of the total level at 5 or 6% is not inherently a big problem. So the fiscal deficit by itself is not a problem. It's that when you have it at the same time as a banking crisis, you have both of them being sort of concurrent problems, if you will. Now, the shameful thing as far as India's macroeconomic situation is concerned is we have a revenue deficit or a primary deficit, if you want to think of it that way. And that is that even without counting interest on debt on a day-to-day basis, your revenue falls short of your expenditure.
Right. I mean, we're borrowing to pay for salaries also.
Correct. So that's one element, but you're borrowing for expense.
Right. Rather than for investment.
Year. So you're not even making the revenue related to your expenditure of that year. That is a shameful state to be in. And no government, except very briefly in 2007, we have not been close to a revenue neutral, revenue surplus situation for a long, long time.
Right.
And nobody has stated it as a specific objective. So without getting too much into the fiscal accounts, I would say the revenue deficit is shameful. The fiscal deficit itself is okay now. But we don't have surplus cash lying around for us to fund $100 billion of a hole in the banking system.
Right.
And so we have no choice but to sooner rather than later to break this into two problems. And
okay. And the final question, has the bankruptcy law helped?
Conceptually, absolutely. And in fact, it could be a major help.
Okay.
So in design terms, it is absolutely the right solution. It's absolutely one element of the right solution, which is if we go back to where I started this conversation, you have three types of companies.
Right.
The companies that were affected by a softness in demand, but not by malintent or mal prosecution, right? Mal execution, if you want to think of it that way, are ripe for being restructured in a manner in which they can become viable again. And so, absolutely, a bankruptcy process is a major element of the resolution of an NPA crisis broadly, and specifically this one. Exactly how it plays out, we are seeing in the newspapers every day today now. And some of it is testing, which is good. And I actually am quite hopeful that of the first 12 that went to the NCLT, which is the judicial system in charge of the bankruptcy process, at least 3 or 4 will come out in a manner in which jobs are preserved, creditors get back some of their money,
right,
etc. Equity shareholders lose most of the money. Most importantly, the original founder promoters are out of the company. I think that's very, very important, at least in a current Indian context. There's some controversy around that, but I am a strong believer that the old promoters should not be allowed to bid for their companies, which is the current law. But a lot of people are protesting it as we speak. So,
thanks again, Narayan, for coming in.
Thank you very much, Pavan.
Thank you for staying with us till the end. If you have any questions for Narayan or any of us hosts, write into podcast@thinkpragati.com and we'll answer your question in a future episode. Tune in to thinkpragati.com for more brain fodder, as well as extra reading related to the Pragati podcast episodes. You can subscribe to the Pragati podcast on the IVM podcast app or wherever you get your podcasts. We are there everywhere.
The Pragati podcast is an IVM production. And if you like our show, you can also check out their other shows, like the Rotomouth podcast. Hosted by Sanjeev Joshi, the show looks at big automotive stories of the week. Listen in to keep track of new technologies, entertainment, policies, vehicles, and more to better understand the auto industry in India at large. New episodes out every Monday on ivmpodcast.com, the IVM podcast app, or wherever you get your podcasts.
There she stands, a podcast addict. Outside the bank, having traveled several miles to get in with other poor souls like her. The journey, though daunting for this youngling, will have some comfort because she has downloaded her favorite podcast. You can see more of her species on ivmpodcasts.com, your one-stop destination where you can check out the coolest Indian podcasts. Happy listening.